And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. Okay, so this morning, everyone wakes up and sees the market, pre-market, down 500. But this afternoon, the market went positive. So I'm going to explain what happened with that. But everyone thought this morning the negative 500 pre-market had to do with Iran, but it didn't have to do with Iran. It had very little to do with Iran, in fact, because Iran was already in the mix by this morning. So let's break it down. The real problem today was AI. That's right. Now, we've been listening to AI, and from time to time they'll tell the truth and say that AI has a problem because of all these centers they built, cost trillions of dollars, and the investors are getting little in return. But they mask that, and a day or two later, a week later, everything's okay again because Joe Sunkface just put in $22 trillion of his personal money into an AI data center. Everything goes crazy again. But that's the real problem. The AI is the underneath, the stream that's underneath is eroding AI. Not that anything's going to happen, but it's just there. And the smart money knows it, and the smart money will rotate their money out. That's what happened. This was not down 500 points today because of Iran. That's already in the market over the weekend. So now, and some of the stocks that got hit, or what brought it down to 500 points, was NVIDIA, CrowdStrike, Oracle, GoDaddy, the same players. Now, another thing that took the market down 500 this morning was inflation. It's showing its head again. Private credit stress. Now, what's private credit stress? That's where non-banks will loan to a company money, and now the company has trouble paying it back. Like they used to call them shadow banks. So instead of JP Morgan, Goldman Sachs, or Citi, or the Wells Fargo, those banks will fund another bank. It's like a shadow bank. It's like off-balance sheet financing. But just think of it as a bank, a shadow bank. So when a bank doesn't want to take risk and loan to some company, then most of the time the bank will fund another company, which they mostly control, put the money in, and then they'll loan it. Well, right now, there's a lot of problems. It's all catching up, a real bad situation. A lot of the money that's been lent to these companies by the shadow banks is cracking up. It's in real trouble. So that's another thing that took the market down 500 points this morning. But what caused and also, of course, the geopolitical risk that we're having with Iran, that did contribute. I shouldn't say it did, but it did. Something else is going on. Let's go back to the 4% yield, the neutral gauge, as we call it. Now, that 4% barely moved today. And that 4% allowed the market to swing from a negative 500 to a positive 500. So that 4% yield is still sitting in place, and it's not going to move, not anytime soon. So this is what you're going to get. You're going to feel, like I told my gang members today, is what you're going to feel. And so that 4% yield is important because it causes a market pause. And when institutions are buying stocks, they make the decision based on the cost of money, Fed fund rates, the value of the money, the 10-year Treasury yield. Now, when yield's sitting on 4%, they don't know what's going to happen. Will the yield, if the yield will break above the 4%, then growth stocks get hit, like tech stocks. Now, if it goes below 4%, then value stocks, like banks, get hit. So when you're at 4%, it's the decision point, and nothing's moving, and that's what we're sensing right now. That's why it went back negative 500, back to positive 500, and it also had help from the plunger team, okay? Now, so that 4% yield is very important, okay? And in the meantime, what's happening is you'll see companies, and I can show you on my chart here, this may help you to understand. If you take a look at, for example, let's take, we'll take the S&P. Now, if you bring the S&P back about a year, you can see how the S&P had nice pricing. That's what this is, pricing. It's going up. Beautiful, right? Just kept going up. But something just recently happened right here. So what you got going here right now, it's not going, pricing's not going up, it's going sideways. So let me bring that back. That's a year. Let me bring it back to 6 months. Let me bring it back to 3 months. Yes, 6 months, you can see it better. So 6 months, let's put it into 6 months, you can see it better right here. So we have this consolidation. That means the institutions are not putting money in because we're at that 4%. So that money is just stuck there, okay? And you're seeing a lot of that with different sectors in the market. And so that's why you got to be very, very careful as a trader. And you got to, you got to really watch what's going on with that 4%. And at the same time, as I told my members, if the yields are down, like they were this morning, then you go long, try to find, consumer stocks that are strong. Try to, if yields are dropping, and try to find, some tech stocks that could be strong. Find, let's say communication service stocks, utilities, those sort of things. And if yields go up, you short instead of go long XLK. You short instead of go long utilities XLU. That's how it works. So you got to know what sectors, how they react with the yields. If you don't, when yields go up and down, if you have no idea if the sector you trade will go up or down, you're going to get hurt. And 99.99% of traders don't know what happens to the stocks they're trading, what group it's in, number one. They don't even know what group it's in, but that group, how that group be affected because the yield's going up and down. Very important that you know that before you trade, okay? So, now, also people believe about 68 to 70% of people, this is the big one, the reason why the market doesn't go down anymore. 68 to 70% of the people, traders, believe the market will never crash again. Imagine that, will never crash again. And the main reason, because they're responding to the psychological history or policy in the past, or our history of policy, our institutional behavior. And that belief has become stronger after every intervention since 2008. So again, people only remember the rescues. They don't remember the crash. So 2008, remember we had QE1, QE2, QE3, 2010 through 2016, zero rates. Can you imagine that? 6 years, zero rates. And the problem with that is a lot of these stocks that used to trade at, let's say, $85 are now trading at $300. They are going to get really whacked. This is going to be one of the worst crashes ever in history when it comes. But most people, as I said, 60, 70% of people don't think it'll ever come. So we've got, and then remember, you had the Powell pivot in 2018. Matter of fact, I remember I called that crash, and then they turned around and popped that market right back up. 2020, right? We had another crash, right? And QE came right in and popped it up. So when you look back at history, every time the market crashes, the Fed steps in, stocks rip higher. So the public has the belief, traders have the belief, don't worry, they're always going to save us. It's called the Fed put or the Fed myth. So that's one of the reasons why we have so much money coming in on every dip, because people truly believe this crap. It's unbelievable. Okay, the market's never going to go down again because of our past activity. We made sure the market wouldn't ever go down again. And so it creates this this false invincibility. And this time when we have a crash, it is going to be horrible. I mean, it's going to be great because we can short. Now, the 401k culture, that's another problem. The automatic buying, okay, hides in 401k. 401ks, remember, were designed only to buy. Just buy. That's all you're supposed to do. Just keep buy. Don't worry, just keep buying. And remember, they contribute automatically. Every paycheck buys stocks. Target date funds keep buying regardless of valuations. No one sells during downturns. You're not allowed to. So this creates the illusion that the market always comes back because the system is designed to force buying, not managing risk. That's the biggest problem with 401ks. That's why it's a failed experiment. And there's no off-ramp. Everything, just keep buying. When the market goes down, do nothing, just sit there, and you're going to be okay. It's just, so that's another reason the market doesn't come down anymore. So every time when you're sitting there and you feel, oh, man, we can make a lot of money shorting, it doesn't happen. The market always comes back. And these are the reasons. But they're all bad reasons. They're not solid. They're all myths. So someday when this market does crash, it's going to be a violent crash. The public only hears one message. Buy and hold, stay the course, everything's fine. And what they don't understand, the liquidity, institutional liquidity that drives, remember what drives stocks is institutional money. Is liquidity. That's what drives the stock. And institutional liquidity masks how fragile the stock market is. And so, again, it's always that liquidity. That the liquidity equals how fast the biggest institutions, there's 10 to 13, let's use 10, that money, that liquidity, okay, it's moved by the institutions through pipelines. Think of them as pipelines. It's not cash, it's the tremendous liquidity, is the tremendous power or the balance sheet of these 10 institutions and their ability to push their cash, i.e. their balance sheets, through the different channels. That's why people are so wrong when they don't follow institutional money. If you just would follow the institutional money and the bond yields, you'd never be making mistakes. You'd always be making money. So liquidity is not actually, it's not the cash you think of that's sitting in a bank account somewhere. Liquidity is how fast these 10 institutions with their powerful balance sheets, can push money through those pipes, those pipelines to the stocks they're being bought. And that's why when we always say follow the money, you follow that money through the pipelines. And it leaves a footprint behind, so you can see exactly what stocks are being bought. But 99.99% of traders don't understand that. They don't do that. Instead, they follow the dopes. They follow the dopes on TV. The jibber jabbers and the financial people on TV and podcasts, and I mean, it's incredible. The stuff that's being said out there is so crazy. So I hope you understand. That's why it feels like the market will never crash again. But it will. Believe me. See you on the charts.
Are you nuts?